So hello guys, yesterday we looked at candles and then we explained several things and you know focused more on bullish candle, explained how time and price, talked about supply and demand and all of that. So today we're going to now look at supply and demand. Now demand and supply. So demand could actually be viewed as consumers, while supply can be viewed as producers, rather, not sellers, producers. So when there is demand, there are people willing to have something at a cost, and that cost could be money or currency. Now later we'll discuss about money and currency, the difference. Now when you're talking about supply, when there is supply, there are people willing to give up something at a cost, and that cost could be money or currency. And the similarity therefore is that each of both parties are both giving up and receiving at the same time. Now for demand, we have buyers. For supply, we have sellers. So let's get to understand some certain things. When there is a higher demand and a lower supply, price goes up. So for instance, let's say, let me use this. So let's say there are a lot of people demanding to buy something, and then maybe there is a little bit of this supply. Now what will happen to cover, just as we explained the other time, to cover or to just make people not to feel like I'm not able to buy, what do? We raise the price up. So we do what? To raise the price up. Now raising the price up will now in a way act as a filter, so price will go up when there is high demand and the lower supply, price goes up. Now when there is a lower demand and then we have a higher supply, just like for instance, now when there's a higher demand, we have 100 oranges, we have 100 people willing to buy an orange. Now we have 5 oranges. Even if you as a human being, if there is this so much demand, what do? You raise price. So automatically what? Price goes up. So the same thing here, we have a lower demand, 5 people demanding for 100 oranges. Automatically you have to do what? Raise price down. So it was Bernoulli that explained that price must fall if consumers are to be persuaded to buy more. So he laid the groundwork for modern principles of investment management. So he says price must fall if customers are to be persuaded to buy more. So if you want them to buy more, what do? You have to reduce price. You have to. So automatically when there is a lower demand and higher supply, price does what? Price go down. Now what happens when we have a lower demand and a lower supply? Price accumulates. When we have a higher demand and a higher supply, price what? Accumulate. What do I mean by price accumulate? Price remains almost at a steady price. Maybe this is 0.2 cents, maybe this is 0.18 cents. So you see price like revolving around here, so almost steady, because there is a kind of equal demand, equal supply. So nobody is willing to offer more. There is enough to go around. So there is this, in fact, it might not even just be this, it might just be like a steady price in one direction of, like, let's say 0.2 cents. 2 cents, $0.2. So now let's go further.